Hi, my name is Randy Bruns and I'm with Model Wealth. What we are going to talk about in this video is we're going to demonstrate sequence of returns risk using a Microsoft Excel worksheet that we put together. And I'm just going to walk through how the worksheet works, and then we'll show you some pretty cool analysis using the data in the worksheet. So let's just walk through this worksheet and look at or get an idea of what we're looking at here. These are various asset classes that might comprise a diversified allocation. So US large stocks, US small value stocks, foreign large stocks, foreign small value stocks, emerging market stocks, real estate stocks, US bonds, foreign bonds, and cash. And what we have along this column here is a 20-year period of returns from 2000 all the way to 2019. And then if we scroll a little further over, you can see the average annual returns for all of those asset classes. But inflation erodes some of those returns. So in column X here is the inflation adjusted or real average annual return. And at the very far right, column Y, you have the purchasing power of a dollar in real terms 20 years later. Where is inflation coming from? Well, we also have a row down here that shows what inflation was each year. And if you're wondering what are all the measuring sticks that where this data came from, well, U.S. large stocks are the S&P 500 index. The U.S. small cap value stock market is the FAMA French U.S. small value research index. International developed markets are the MSCI EAFE, which stands for Europe, Australasia, Far East Index. And then you can see that the bond market is the Bloomberg Barclays U.S. Aggregate Bond Index, cash, 1 month U.S. Treasury bills. And so let's look at a couple other things. So let's just put a hypothetical portfolio value in here, and we're going to use $1 million. And for starters, let's just put 100% in the S&P 500 index, so large company stocks. So right here, you'll see that whatever allocation we build on in row 14, we're getting the actual returns of that allocation. Right below that, we're seeing what happened to our hypothetical beginning value. So the negative 9.1 is the same as the negative 9.1. The negative 11.89 is the same as the large company stocks negative 11.89. Here you can see $1 million by the time 2009 was over. $1 million fell to $908,981. And that was the lost decade. The lost decade was followed by a really big decade for the S&P 500, which turned that 908,000 into $3.2 million. So now I want to just show how does all this relate to sequence of returns. So let's go to this tab down here. This table here just borrows from the popular 4% rule of retirement withdrawals. So here's how it works. So this is the year 2000 all the way to 20 years later, 2019, $1 million invested. How the 4% rule works is it says that the year one of retirement, if you multiply your at retirement portfolio value by 4%, that could be a baseline withdrawal amount that then you would subsequently increase for whatever inflation was. And that rule of thumb suggests that you should have a high degree of confidence that your funds will survive even the worst of starting periods in retirement. It's not guaranteed, but it is a popular rule of thumb that a lot of retirees and financial advisors suggest as a starting point. So here's what we're doing here. We're taking $1 million, 40,000 is 4%. And then what we do is you can see that inflation right here was 3.39%. So this is how the 4% rule works. You take 40,000 out of your $1 million portfolio, and then the next year you multiply or you increase it for whatever the rate of inflation was. If we multiply times 1, it's just 40,000. But if we multiply times 1.0339, That's going to give us the same amount, but plus 3.39% more for inflation. So the second year, there's the $41,356 withdrawn. And then the second year, inflation was 1.55%. So if we multiply times 1.0155, now you're up to 41,997. Notice over the 20-year period, you took out the equivalent of $1,004,807. But one other thing that's happening on here is you're taking a constant amount from a portfolio whose returns are anything but constant. And remember that lost decade? So these are the returns of the S&P 500, which is what we simulated as our portfolio. -9, -12, -22. Now you get some bigger years here. But by the time 2009 was over, your $1 million had fallen to $395,000. Then we know that the big returns happened in 2000, from 2010 to 2019, but the portfolio had already been depleted so bad that by the time the 20th year was up, you had just $363,069. And your $40,000 withdrawal was now $59,716. It's the same amount in purchasing power from 20 years earlier, but it's a larger amount because of inflation from a much smaller portfolio. So that 59,716 as a percentage of the beginning value of 335,835 was almost an 18% withdrawal. So you can see down here, if we looked at the investment rate of return for that portfolio, which is ultimately the S&P 500, if we look at it and we exclude the cash flows, it was a 6.06% average annual return. But if we take into account the cash flows, your internal rate of return, or IRR, was just 2.59%. Now, here's something that's pretty cool about sequence of returns. What if we said, all right, what if instead of earning this -9, -12, -22, 28.69, so forth and so on, what if we earn those same returns, but in opposite order, in reverse order? What if we started with 31.49, -4, 21, 12, and we ended with a -22, -12, -9? And this Excel worksheet, we can actually do that. What we do is we just highlight all of these cells and we go to sort. Notice that column G is numbered, so 1 through 20. Those are the years. Right now, the default is smallest to largest, but if we do largest to smallest, when I hit OK, all of these returns are going to inverse. And just watch what happens with the $1 million. Instead of 363,000, just watch what happens here. You end up with $1.95 million. The average annual return, excluding cash flows, was 6.06. The average annual returns without taking into account cash flows, it doesn't matter the order of how the sequence of how returns play out. But if you're taking a portfolio withdrawal, especially a constant portfolio withdrawal from an investment whose return is anything but constant, this is where outcomes can differ dramatically. So remember, we had a 2.59%, I think, return, and the ending value was 363,000. Now the internal rate of return, when you consider cash flows, was 7.22%. So that's the sequence of returns. The thing you cannot know is, are you going to start out with a bull market or are you going to start out with a bear market? If you had the choice, if it were possible, you'd always want to end in a crash rather than start with a crash. But that is not something investors have any control over. So let's reverse this back out. And now we're going to go back to this worksheet and we're going to build a more balanced allocation. So I'm just going to put, whoops, what did I just do there? I'm going to go put 20 here. And where did that just go? I put something somewhere. Oh, yeah, here we go. Let's undo that. There we go. So now I'm going to allocate, I'm going to make this, instead of 100% large US stocks, let's just build a a 50-50 allocation might be considered a textbook allocation. We're going to do 20, 5, 12, 3, 5, 5, 35, and 15. So this is U.S. large stocks, U.S. small stocks, international developed markets, international small stocks, international emerging market stocks, real estate stocks, U.S. bonds, foreign bonds. This is a 50-50 allocation. Now, right off the bat, now we see what the blended return was for that portfolio each year. And it's not going to look like any specific allocation, any specific asset class, because it's a mix of all of them. Now here you can see the 1 million was 1.03 million, 1.04, just over 1 million. And then by the end of 2009, remember the S&P example, S&P 500 example, large stocks was like $908,000. This is a $1.8 million portfolio after the first decade. By the time the 20-year period ended, it was 3.6, but the line, the ride was so much smoother. So now let's look at that in terms of our withdrawal tab. So same $1 million, same $40,000 withdrawal or 4%, same inflation numbers, but now what we're doing is we have a smoother line. The average annual return was 6.68% for the 50-50 portfolio. The 40,000 increased for inflation. Over the entire 20-year period, you took out $1,004,807. But in the S&P 500, or the large U.S. stock example, it was the ending value in year 20 was $363,000. This is $1.547 million. It grew the $1 million by $547,000, but it actually lost a little bit of purchasing power, which we know because you can see 4%, which is the 40,000 divided into the 1 million, but eventually that 40,000 cost $59,716 to buy the same amount of goods and services in year 20, but dividing that into 1.38 million is a 4.32% withdrawal. So you're actually, even though your portfolio grew, your purchasing power slightly fell just because you're taking a little bit more out. But the 6.68% return stayed the same, but your dollar-weighted return is 6.52%. So you undercut the investment portfolio with cash flow excluded. You undercut those returns slightly. But now let's do what we just did for the all S&P 500, and let's now do that for the 50-50 portfolio. In other words, we're going to reverse the order of when the returns how the returns played out. So instead of starting with 3.3, 0.62, negative 2.12, and ending with 12, negative 4, and 17, let's start with the 16.89, then have the negative 4, and then the 12, and end with the negative 2, 0, and 3.3. And again, how we do this is we just go up to here to data sort, and we're just going to sort by column G, which are the number of years, and we're just going to go from, it was smallest to largest, but now we're going to go largest to smallest, and we're taking the inflation and the returns with us. So now the $1 million grows to 1.7 million. And you will notice this, that the withdrawal amount total, because inflation tied to the portfolio returns, you ended up taking a little less than 1,004,000, but your 1 million grew to 1.7, and prior it was 1.5 million, which is a far cry from the 363,000 of the more concentrated S&P 500 index with returns in forward order, and the $1.9 million when we reversed order of the returns. That is a very wide dispersion, and that is a dangerous thing. If you catch markets wrong, diversification is a wonderful thing for retirees. It's a wonderful thing in general, but especially if you are taking a constant amount from a portfolio whose returns are anything but constant, you really want to smooth out the degree of fluctuation above and below your long-term average, and that is what diversification does. So here's that same 6.68% return independent of cash flows, but instead, before it was like a 6.52%, I want to say, internal rate of return when you include cash flows. Now it's a 6.78%, but that is a much tighter range of outcomes. Again, sequence of returns can be very dangerous, but this is just a way to smooth out the sequence of returns. But of course, if you're going into retirement, we would suggest you optimize Social Security. In other words, get as much Social Security as you can, and everybody's going to have a different claiming strategy. But you might also want to annuitize a portion of your wealth, that when you combine that annuitized cash flow with Social Security, you establish a minimum floor to meet your whatever lifestyle you need to be happy and live a life with dignity. And basically, if you do that, that improves retirement success. And studies show that we actually, from empirical evidence, see that people spend more and live happier, less stressful retirements. Because if you can get your fluctuation affecting funds that are really just discretionary or luxury, that's a heck of a lot better than having fluctuation affect mandatory expenses that you need to live your life. Hopefully that made sense. If you have any questions, you know where to find us. You can find us on the web at www.modelwealth.com, and there are all sorts of ways to contact us. Thank you, guys.